Okay, hi, this is Derek McDaniel. This is the second video in my series, everything about interest rates, that I expect the second of 6 videos. So in this video, we're going to be talking about how interest is inefficient, okay? In the last video, I went over why interest is going to be relative appreciation between assets, okay? Now, then we talked specifically about debt contracts and how a debt contract that uses interest. A debt contract that uses interest fixes the appreciation of two assets. It's your debt versus whatever the form of money or currency, bank deposits, whatever you're going to be using. So debt credit is imperfect, needs to be upgraded to money. But upgrading is inefficient. So, in what sense is it inefficient? So, the benefit of credit is exchange, okay? Now, when you have an exchange, those two items exchanged should always be comparable or roughly equal value, but actually when you exchange, you perform an exchange generally because the recipient, it's more valuable, both objects are more valuable to the recipient than whoever is giving them. And so then, even though you have the same amount of objects and everything, because the exchange was performed, you end up with more value after the exchange because the people who value those things more now have the assets, okay? So you don't actually need interest. You don't need interest to make lending worthwhile. This whole exchange of value is sufficient to make lending and credit worthwhile, okay? Now, once your credit is usable as money, however you do that, whether you convert it into money and store it at a bank, however you do that, then it's good to go. It's going to be functional as money. You don't need an interest rate once you get it upgraded to general use. Now, if the person making the loan to you had to hold on to that asset, that your debt, then there would be an opportunity cost. But generally, it is now a financial asset. It's good for exchange relative to however it's valued or priced. So the real cost is not an opportunity cost or like anything like that. The real cost is just upgrading it so you have good credit, okay? And this is another reason why equilibrium rate doesn't really make sense, because as soon as you've upgraded enough, your credit is money, so there is no lending equilibrium rate. You're just trying to upgrade your credit to money. Okay, now the thought experiment I am going to use to try to demonstrate that, let's say you decided you wanted to counterfeit money. Now, this is sort of similar to what we're talking about with upgrading money, but instead we're just going to be lying to people to take them as fools or whatever, to convince them our tokens are actual money. So what we do in this thought experiment, let's not do it in real life, we create fake money, but then we put trackers in this money, okay? So let's say instead of taking a loan for $100,000 to buy a house, you counterfeit the money and you put trackers in all the money, and then as that money is circulating every month, instead of making a mortgage payment, you go out and track down your counterfeit money and swap it out with real money as much as you would make in the mortgage payment. Okay? Now, in this scenario, as long as no one detects, if no one detects the counterfeit, who is harmed? Okay, so these people are exchanging money, but you go track it down, you find it, and without their knowledge, you swap it out for real money. So they thought they had real money, so you didn't have to borrow money, but now all of a sudden, it is actually real money. So the person who initially received it isn't harmed, and the person they gave it to isn't harmed as soon as it gets swapped out with real money. It's as if it had been real money the whole time, okay? So then if this is possible, what is the harm? And why pay interest? Okay, now one explanation for why this may not make sense is that when you create money, you may be increasing spending and depreciating the value of money. So you're counterfeiting, even though it was replaced out, you could be decreasing the value of money. Okay, now importantly, I'm saying could, and we'll get to that in 3 more videos where we talk about quantity theory of money versus equity theory of money. But for now, we'll just note that even the act of counterfeiting could have a negative impact on money, even if you're able to replace that counterfeit money with real money eventually. Okay? Now, I will argue that it doesn't under normal scenarios, that even though that's possible, that shouldn't. We'll go over all of that in equity theory of money. So there is this, we'll just say, possibility more money impacts money value and other exchanges. Okay, so because you were able to buy that house, maybe someone else has to pay more for a house. Okay, now that is completely possible. Okay. And so basically, if you want to have the best possible exchange, if everyone had perfect knowledge and you were able to price people's credit accurately, you would either treat it as money or as nothing, okay? You would just price it whatever it was, whether their word was good or not, and so you wouldn't need money. You could just operate strictly on credit and everybody would be fine. So the very act of charging interest for debt means credit is more expensive, so you're reducing those beneficial exchanges. Okay? So you're just reducing, if someone is accepting money, then they're accepting a deferred exchange anyway. So accepting money is always accepting deferred exchange. No opportunity cost compared to credit. Okay, so that gets back to our relative appreciation or depreciation. So the more your interest, you're just going to make it fewer beneficial exchanges will get fulfilled because the exchanging parties won't have things to exchange without some type of external loss of value to some overhead cost. Inefficiency is reduced exchange from the entity upgrading the credit. Okay, so that's gonna be it for this second video. So interest is just plain inefficient. It's not pricing of time preferences or anything like that. It's just like money works as credit, credit works as money, and your money is just inefficient for pricing exchanges. So you get fewer beneficial exchanges because of imperfect information. Okay, thanks. I hope you appreciated enjoyed this video, and let me know if you have any comments or questions, and we'll continue next time with interest is discrimination based on predictions.